Good afternoon, everybody. Thank you for joining us for today's webinar, Value Investing, How It Works and Why. At Counterpoint, we run a multi-style boutique asset manager. We have a variety of franchises within the business. Of those franchises, to just run through them, we've got fixed income. We do have the Players and Growers franchise, the Quality franchise, the Quantum Mental Core, and then the Value franchise that we will be unpacking today. I'm Jaco Brandt, I head of distribution for Counterpoint Asset Management, and I'm joined by Piet Viljoen, who is the lead portfolio manager within the Value franchise. Piet will take us today through the local value fund as well as the global value fund, and then also the worldwide flexible fund, which I know he's very excited to talk to. Just before we jump into the presentation, as always, we just want to run through a bit of housekeeping. We use GoToWebinar as a platform to host these sessions. The first thing that usually goes when you've got bandwidth issues is your sound. So for the best possible experience, please close down all unnecessary applications that might be running in the background. Then for CPD points, we do apply for CPD points with the Financial Planning Institute. We do this once the session has closed, and it usually takes us about 3 weeks if we get those CPD points approved by the FBI to send out these certificates to all qualifying attendees. Then at the end of the presentation, we've got a very short survey. It's going to take you 30 seconds to complete that for us. It really is important. Your feedback is extremely important to us. Please take a minute to complete that. It helps us to improve these sessions going forward. And then we do have a question box as well. So you'll see in your navigation pane, if you do have any questions, please do post that during the course of the presentation. Pete will run through the slide packet itself, but we will definitely have roughly 20 minutes at the end, if not longer, to discuss any questions that you might have posted in that question box. So please do take a minute and ask us any questions that you feel we haven't addressed during the course of the presentation. So without further ado, I'm going to hand over to the man of the hour, Piet Viljoen, who recently won 2 Raging Bull Awards, but more importantly, finished the Cape Town Cycle Tour within 3 hours and 11 minutes, which I think is an incredible achievement in itself. Thank you, Piet.
Thank you, Jaco. I can report back that I am now completely dry after the events of the weekend, which was quite wet. So I just want to confirm that you can see the screen and the presentation in front of you, Jaco. Is that up and running? Is that clear?
100%, Piet, you can proceed.
Okay, so I can carry on. So what I want to talk to you about today is the whole range of activities in the Counterpoint Value franchise. But before I get to all those funds, I'm just going to very quickly deal with what value investing tries to do and why we think it works very well. Then I'm going to touch on some key fundamentals driving global markets today. Then I will talk about the 3 funds within the franchise, within the Value franchise, the South African Value Fund, the Global Value Fund, and the Counterpoint Worldwide Flexible Fund. Each fund is distinct from the other and tries to do different things for different people. So hopefully you'll find each little presentation on the fund, on each different fund, interesting. So let's talk about value investing. Let's kick off with that. What is value investing? So when you look at an asset and when you try and value an asset, there are 3 components to that valuation process. The first is the intrinsic value, or the business as it currently stands, the earnings power of that business or asset as it currently stands there and then. We're not looking into the future. We're not trying to project anything. We're just saying, what is it currently earning? What assets has it got on its balance sheet? What liabilities and so on? What's its net worth? What is the intrinsic value of the business as it stands there today? On top of that, one can add future project value. In other words, any future activities this business will undertake, and also deduct from that valuation the capital that's required to undertake those activities. So there's some sort of value to the future projects of the business. And then thirdly, the value of the story. Many businesses have strong storylines, and as Yuval, in his book Sapiens, I forget his full name now, very clearly illustrated, human beings love stories and react very positively to stories. So if you have a company with a strong storyline behind it, it can attract even a higher valuation. So you've got your intrinsic value, you've got the future project value, and then you've got the value of the story. Those are the three components of any company or assets valuation. So what value investors try to do is we start at the bottom. We put the heaviest weight in our valuation work on the intrinsic value of the business as it stands there today, without making any making as few as possible predictions about the future, because we recognize we just don't know what the future holds. The future continuously surprises us, and we place the least value on the story behind the stock. So value investors work from the bottom up, and we place the heaviest emphasis on intrinsic value, whereas growth investors work from the opposite direction. They place almost the heaviest emphasis on the story of the company and the story of the stock, and they project that story into the future and try and ascertain some sort of value of the future activities which the business will undertake. And then lastly, they will look at whatever's on the balance sheet today and its current earnings power, but they almost discount that completely. That weighs the least in their estimation of the intrinsic value of a business, or the value of a business. So growth investors, value investors basically are two sides of the same coin. They look at the same things, they just emphasize these elements in a different fashion. And there isn't a wrong way or a wrong way of doing these things. They can both be right, and there's many other ways of going about your investment process. The important thing to remember is when you're evaluating a value investor or a growth investor or any other investor's process, it has to be credible and defensible. You have to be able to defend why you're doing what you're doing, and it has to be credible. In other words, you have to show why this way of what you're doing works. And I hope as I go through this presentation to show why value investing works and how it works. So that's just in a nutshell how value investing works. If one then looks at the current market environment, what is happening out there? And I think this slide, which I love showing because I think it encapsulates so many things. This is basically commodities relative to equities. The Goldman Sachs Commodities Index relative to the S&P 500 Index. When this line is going up, it means commodities are outperforming. When the line is going down, it means stocks are outperforming. And you can see that ever since the global financial crisis in 2008, stocks have been outperforming and commodities have been underperforming. The other thing you will notice when you look at this chart is there is a clear, roughly 20-year cycle from peak to peak or trough to trough. And there's a reason, there's a fundamental reason for that. It's not arbitrary. It has to do with the fact that when commodity price gets very high, commodity producers are incentivized to produce more. They start building mines and drilling holes and exploring more and so on and so forth. But it takes to build a new mine, whether it's a copper mine or an iron ore mine or whatever, to build a new mine from inception to first production can take, depending on the commodity, anywhere between 5 and 15 years. Let's say on average 10 years. And that is why there's a 20-year cycle from peak to peak or trough to trough. There's a fundamental reason for that. When commodity prices were super high in 2006, 7, and 8, and commodity stocks that outperformed quite strongly, mines started investing in new capacity, and a lot of new capacity. That capacity came on stream in 2011, 2012, 2013, and depressed commodity prices. So all of a sudden, you've got a lot of commodities coming onto the market, which depresses prices again. And during that period, we also had a global upswing, and equities started outperforming, and have been outperforming ever since then, until quite recently. You can see right at the bottom there, at the bottom right-hand part of that chart, commodities are starting to outperform again, but it's still very early days. The other thing I want to point out when one looks at this slide is that this cycle coincides with many other cycles, and they are fundamentally linked. So the first thing is when commodities outperform, emerging markets tend to outperform. And the reason for that, of course, is emerging markets are generally dominated by resource extracting businesses. So when resources, commodities are doing well, emerging markets tend to do well. The second cycle that goes along with the cycle is that when the commodity cycle turns up and commodities outperform, generally value investing tends to outperform. And why is that? Because value investing tends to focus on the intrinsic value, the asset values of businesses, and not on the stories. So when commodities are on the upswing, it's the intrinsic value of businesses that start generating really good returns. Asset-intensive businesses start generating really good returns because their output prices are going up. So these cycles go together: commodities, emerging markets, and value investing. There are different linkages between these all, but those are generally the trend. And if you look back at this chart through history, you'll see that these things always roughly coincide. Now, the interesting thing that's happening right now, despite commodity prices being up quite strongly over the past year or so, and the return on assets of commodity business, which is the blue line here, just recently went up over 10%. Return on assets over 10% commodity business, as high as it was just before the global financial crisis, when we had the previous commodity boom. So the chart is showing that commodity business today are as profitable as they were 15 years ago. And you can see the red line, which is net investment as a share of global GDP by these companies. You can see as commodity prices went up in the early 2000s, net investment went up, and even after they turned down, continued to go up, which eventually created the surplus of commodities, causing commodity prices to turn down. But what's happening right now is quite interesting. With returns on assets going up, in other words, profitability of these businesses going up a lot, they are investing less and less and less. And the reason for that is quite simple. Due to this very strong emphasis on ESG, many jurisdictions, many governments, many communities, many investors refuse to finance resource extractive businesses. Instead, these corporates are encouraged to rather return cash to shareholders and refrain from expanding their business because they are bad for the environment. The problem you have with that, of course, is that as the demand for these inputs increases and there is no additional supply being created, these prices could go up a lot more. So we think that this cycle has just only started. And the reason I say that is the same people who are stopping extractive business from expanding are saying we need clean energy, we need the energy transition to happen, and it needs to happen quickly. We need clean energy. We also need to fund this Build Back Better. After the coronavirus pandemic, we're going to build back better, so we need to fund the infrastructure spend. So there's a lot of capital pressure, capital expenditure pressure being put on economies to build a clean energy infrastructure, to build solar power producing plants, to build wind turbines. But all these things require resources. They require lots of steel, lots of cement, lots of oil and gas, because how do you make, the components of a turbine is made out of oil and gas derivatives. So it requires a lot of these commodities, yet the producers are being stopped from producing more. So there's a disconnect happening, and we think this disconnect play out in a very interesting fashion over the next 5 to 10 years. And that will augur well for emerging markets, it will augur well for value investing, and it will augur well for commodity prices generally. So that's, in a nutshell, what's going on in the world. At the same time that these fundamental things are happening in the world, South African and emerging markets are the cheap parts of the world. Those are the parts of the world where no one really wants to invest. This is just a forward price earnings ratio of different indices. And you can see broadly grouped on the right-hand side, the expensive side of this chart, you've got the US stocks, NASDAQ, Russell 2000, S&P 500, you've got the Swiss stocks, you've got Australian stocks, you've got Japanese stocks, you've got European stocks, French stocks. Broadly speaking, this is the expensive part of global markets. And here on the left-hand side, you've got the cheap side, Russia, Brazil, JSE small caps, which are one of the cheapest stocks in the world, or sectors in the world. You got Brazil, you got Hang Seng, Hong Kong, and interesting enough, UK, which some people even regard as an emerging market these days since it's divorced from Europe. And China is sitting there as well. So you've got the emerging markets on the left and cheap side, and you've got the developed markets on the expensive side. So you actually have a confluence of factors here, which is very, very favorable towards investing in South Africa, given that we've got a bull market in commodities, which could lead to a bull market in emerging markets, which could lead to a bull market in value stocks. And that's exactly where South Africa is positioned. Emerging market, commodity producing, value situation. So we remain optimistic on the situation in the investment outlook in South Africa, as opposed to the fundamental political outlook. Those are two different things. So that's just by way of a thumbnail sketch of what's going on out there in the world. And those thoughts drive the composition of the Counterpoint Value Fund, the Counterpoint Worldwide Flexible Fund, and the Counterpoint Global Value Fund. So just bear those in mind as we go through these three funds. So the Counterpoint Value Fund, the South African Value Fund, its investment universe is South African listed companies. It doesn't invest, it doesn't take money offshore, it invests purely in South Africa. We believe investors can make their own decision as to how much money they want to invest offshore and how much money they want to invest in South Africa. And with a recent further relaxation of exchange controls in the budget last month, there is even more freedom for South African investors to invest the way they think is appropriate. So we're not trying to prescribe to you how much in South Africa, how much offshore. We think you can make up your own mind about that. This is a South African fund and invests solely in South African listed companies. It is unashamedly managed according to the value investment style. So you'll see it looks very different to most other funds out there. As a result of that, there are very few value managers left. Value has underperformed now for 10, 12 years since the global financial crisis, as you saw in that previous chart. There are, most value managers have given up. So we think it's still very different to most other funds. The fund is managed with a strong focus on risk management. And the fund manages the risks not through trying to be a better forecaster of what's going to happen, but by being a better manager of exposure to different risks. And the more riskier the exposure is to a certain outcome, the smaller the position will be, and the less risky, the bigger the position will be. So we use position sizing as our primary tool for risk management. So when we think something is highly risky, but has a return profile which is highly attractive, we will invest in it, just a small proportion of the fund. So that's how we manage risk, is through position sizing. And also, the second thing we do is we try and put together a fund that consists of exposures to risks which are different to each other. For instance, a portion of the fund is always invested in what is called net current stocks trading at a discount to net current asset value, or liquidation value. So whenever we look at that, and we look every 3 months or so, we screen this out and we look for stocks that are trading below liquidation value. And in a cheap market and a market which is so disregarded by most investors, South Africa has quite a few stocks like that. Good businesses which are trading below liquidation value, we just buy them. And we put a basket of them together. And we also buy spin-offs. When somebody like Naspers spins off a company like MultiChoice, we buy that and we hold it for 3 years, and then we sell it. Because spin-offs generally tend to do well as management is focused on their business. And that's been, there's been a lot of research that's gone into proving that, that outcome. And the interesting thing is, what drives the returns to spin-offs is very different as to what drives the returns to companies trading at a discount to net current asset value. And what drives the return to property stocks is different to those three again. So if you can put together a portfolio made up of different risk exposures, it's like a bundle of twigs, which is the little picture you see there in the background, where each individual exposure is highly risky and can have an adverse outcome. But if you bundle those risks, exposures together in a bundle and tie a string around it, you've got a portfolio which is very strong and robust. And that's what you're trying to do with the value fund. Finally, we will limit the size of this fund. We think it is very important for it to be able to invest across the market cap spectrum of the South African market. So from small caps to large caps. Now, if you're running a fund of 5 billion or 10 billion rand, there's a lot of small caps. Now, I'm going to show you an example just now, which you just can't buy. It's just impossible to get exposure to those. So the bigger the fund gets, the less diversified it becomes, and the returns then suffer from that. And you can see that with most big funds today, the returns have suffered. So we aim to keep this fund relatively small, and so we will cap the size of it at some point in the future. Here's the track record of the fund. It's been a good time for value over the past year in South Africa. Value stocks, specifically small cap stocks, have done fantastically well. And because this fund has exposed to small caps, it has done really well. It's done more than double the return of the All Share Index over the past year. You know, few people would have thought the All Share Index would grow at 19% over the past year. Most people are very bearish on it. The Counterpoint Value Fund has done 48% over that same period. The average general equity fund has done 20%, which is commendable. Over 3 and 5 years, this fund has also outperformed both the All Share Index and the average general equity fund by a lot. And those returns are satisfactory. A 5-year return of 17%. And remember, the rand is basically flat against the dollar over the past 5 years. That's a 17% per annum dollar return, roughly. That is not bad. So despite a dire political outlook, despite an economy which is going nowhere, despite massive negativity from local investors, the All Share Index has done fine, and this fund has done fantastically well because assets were priced with even worse expectations. So remember, when you're investing, you're not buying the underlying, you're buying the market's expectation about the underlying. And if the market's expectation is so negative, it's even worse than the actual outcome. You have a bad outcome, but still a good investment return. And that's exactly what is happening in South Africa today. The expectations that are baked into share prices so negative that it's, that it delivers good returns because the actual outcome, although it's bad, is not as bad as what is baked into share prices. And then the second very important point I would make here is that most equity funds cannot outperform the All Share Index because they're too big. They just can't go into those parts of the market where there are excess returns available. And that's clear over almost any time period you get to pick. So those are the returns for the fund. This is an example of one of the twigs in the fund. The stock is Rebosis A shares. Rebosis as a two classes of shares, A and B shares. The B shares get all income, and the A shares get the capital growth and some of the residual income if there's enough. And we think this is a very interesting deep value situation. Basically, Rebosis is trading at a 90% discount to the book value of the properties on its balance sheet. At the end of the financial year, the properties were worth 31 Rand 88 cents a share, almost 32 Rand a share, and the share was trading at 3 Rand 50. I think today it's trading at 2 Rand 70. So it's trading at a massive discount to the book value. And towards the end of last year, they announced an action where they would sell half their properties at a slight premium to book value to an unidentified investor. So if that deal happens, the NAV per share actually increases to 34 Rand 89 cents a share. So you call it 35 Rand, where the share price is extremely low. So very undervalued. The big risk here currently is the loan to value is at 71%. So it has high debt levels, which can cause bankruptcy if they can't get enough income from their properties. So that's the big risk here. This is a candidate for bankruptcy. However, if they manage to get the disposal of their book or half their portfolio properties away, then the bankruptcy risk reduces significantly. Loan to value goes down 46%. There are most A shares. Sorry, I mentioned incorrectly. The A shares get the earnings, the B shares get the capital growth, and the fund owns the A shares. The distributable earnings in the previous financial year was 83 million rand. The entitlement according to the formula was 185 million rand, but they didn't pay anything out because they need to retain earnings to pay off debt. But if they can get this disposal away, then they will have enough earnings to pay almost 200 million rand worth of distributions. That's on a market cap of around 200 million rand right now. So you can get the whole market cap in 1 year's worth of earnings. That's if they can get the disposal away. So we think it's a highly speculative, event-driven opportunity. The successful disposal of their properties would put the company on path to sustainability, and we think that the A shares are entitled to the bulk of the near-term earnings potential, which would cause a massive re-rating of these shares. Now, we originally bought the shares at 70 cents a share. They're trading at £2.70 now. We can see them going to 10 rand if they do the transaction. However, if they can't do the transaction, this company can go, there is a significant risk of insolvency. Equity holders are going to walk away with nothing. So what does one do as an investor? Do you avoid this? Do you stay away? No, we as value investors with our investment process, we will take a small position in the stock because if it works out, we make 10x. And if it doesn't work out, we lose the small position. And if you can bundle a whole bunch of these small positions together, some of which will work out and some of which won't, you end up with a decent return, as we've seen from the history of the fund. So this is the position. Initially, we bought 0.5% of the fund into this at 60 or 70 cents a share. Today's £2.70, and so that's the most we can lose, 0.5% of the fund. That's like when Naspers was 25% of the index. That was like Naspers going down 2% on the day. So puts the risk in perspective. So that's the type of thing we buy. It's not the only type of thing we buy. You'll see the top 10 holdings in the fund are mainly large caps: Exxaro, Nedbank, Anglo, Sasol, Absa, British American Tobacco, Sibanye, Goldfields, Discovery, Glencore. So, it's not only small, fragile twigs that we buy. We buy some really good, large businesses as well. But as you can see from the slide in the middle here, we are very underweight the large cap stocks and very overweight the mid and small cap stocks because we think this is where the value in South Africa is. This is the neglected part of the market, the part of the market where everybody just sells to take their money offshore, and where the large fund managers cannot get involved, so they just are not buying anything there because they're just too big. So it's a neglected part of the market, and it holds, we think, very, very attractive investment propositions out there. Relative to the all share, this is our sectoral exposure. You can see we are heavily overweight industrials, energy, financials. Those are the South African focused businesses. The industrials those are the smaller mid caps, SA Inc. type businesses. Those are the businesses whose investment prospects we are the most excited about. Do not confuse being excited about investment prospects and overall general economic prospects. Those are two different things. They're not the same. So that's the value fund, and it has quite a lot of resource exposure, as you can see, and expect Exxaro, Anglo American, Sasol, Sibanye, Goldfields, Glencore. So significant resource exposure. This commodity cycle is only in the early on in the first innings. I think there might be one or two batsmen out, but I think there's still, this tail can wag. So in conclusion, we think the Counterpoint Value Fund is very different to most other funds and even some of the other value funds out there, because some of them are quite big and cannot invest in the same sort of names that this fund can invest in. Very importantly, we think South Africa is cheap enough to include in a diversified global portfolio. So if your neutral position in South Africa is 0, 100% offshore, 0 in South Africa, we think it makes sense to allocate a small portion of that to South Africa under current circumstances and current valuation parameters because it's so cheap. And we think the Counterpoint Value Fund is the ideal vehicle within which to do so, because we think there are very many cheap, uncorrelated opportunities available in this market because it is so neglected. And finally, as I said earlier, we think the size of the fund is a distinct advantage. Right, moving on quickly to the Counterpoint Global Value Fund. This fund invests in global equities across the world, developed and emerging markets, very definitely managed with a value investment process and philosophy. We do not manage it with reference to index weight, so we don't over and underweight things, very much like the Counterpoint South Africa Value Fund. And it's diversified across strategy, across industry, and across size. So there are small caps, large caps, all different industries and all different strategies, and very much high quality and low quality. High quality businesses dominate the fund, but we also invest in low quality businesses if they are cheap enough to pay us for the risk of doing so. And again, this fund is a bundle of twigs. Talking about the investment process of the Global Value Fund, I think the key point of departure for us is we know that we don't know. We don't try and pretend that we know everything about everything, because we don't. How do we deal with that? First of all, we look only at what we can find to be undervalued, whether it's a sector like energy, whether it's a country like South Africa, or a concept like clean energy, nuclear, for instance. Then the risk management consists of position sizing, as I also spoke to you about in the South African Value Fund. We do the same in the Global Value Fund. We add weight or deduct weight from a position if it shows positive price momentum or negative price momentum, because we think the market is smart, probably smarter than we are, and we have to recognize when it is picking up on a story or discarding the story. And finally, we manage risk through running a thoroughly diversified fund. And we try to have a balance across sectors. So we don't go all out on a limb. If we're very bullish on commodities, we don't invest the fund 100% in commodities. We invest significantly overweight in the sector, but we don't go all out on a limb, because we think, we don't know what the future holds. So we might be completely wrong on the whole commodity cycle, and we don't want to expose investors to that sort of outcome where when you're wrong, you lose all your money. So how we size position in the fund, we look at what sector the company is operating in. If we're bullish on the sector, we will add a bit of weight. If we're bullish on the country, we add a bit of weight. If we're bullish on the concept, like clean energy, for instance. And these all presuppose, of course, if the stock is cheap enough to buy in the first place, because we are value investors, we only buy stocks that are undervalued. So if a stock is in a sector that's cheap, like energy, because the energy sector as a whole is quite cheap today, and it is part of a concept that we are starting to back, like the provision of clean energy through nuclear energy, then we'll add a bit more weight to that stock. Or if it's a country that's cheap and the company has a certain concept, we'll add a bit of weight to that stock. And then if you have the situation where it's a cheap sector, a cheap country, and a cheap concept, then we'll have the biggest weighting in that stock. So that's how we size the positions. And the positions are on, as I said earlier on, the positions are fairly small. We don't go all out on a limb. This is the top 15 holdings. You'll see even the stocks we're most bullish on are not huge positions. The fund is very diversified, and you can see that if I had to take away one theme from this slide, it is undervalued superior investment businesses. Businesses that can invest capital or generate superior returns on invested capital on behalf of shareholders. Aflac is one of those, Berkshire Hathaway is one of those, Fairfax is one of those, Markel Corp is one of those as well. Those are all basic investment companies that own insurance businesses. In other words, they get access to a float and they invest that float and earn superior returns. And those stocks today we think are quite undervalued because the market doesn't like that story. It's not a story the market likes right now. At some point in the future, it might like that story, but not right now. And then, of course, we have energy as the other big theme here. Peabody Energy is a coal mining business. We think because of the poor energy transition policies in places like Europe and even some other developed markets, they are now forced to become increasingly reliant on coal, and therefore coal businesses are doing fantastically well right now. And we think that there is a place for coal in the energy sector because it is a cheap form of fuel, and emerging markets need cheap fuel inputs to grow their economies. And Cameco is a uranium mining business, so it's part of the energy. That's part of the energy sector, and INPEX is a Japanese. It's a Japanese oil and gas exploration and production company. So there's strong flavor towards energy and strong flavor towards undervalued investment companies. Relative to the MSCI, the geographic breakdown, quite underweight the US. As I pointed out, developed markets we think are fairly expensive. So US underweight, Europe underweight, Switzerland, Australia underweight. The other here is emerging markets. It's markets like Brazil, South Africa, Argentina. We had some Russian exposure that has gone to zero, but because of our risk management policies, we didn't have big exposure there. I think our maximum exposure before the meltdown in Russia was 2% of the fund. And that was so, we were very bullish on those companies. We thought they were very cheap, and we were wrong. But our risk management policies limited us to 2% exposure. But we remain bullish on emerging markets. That's our biggest overweight in the fund. We are overweight Japan, and the other emerging market we overweight on is the UK. Canada, we overweight. That's developed market managed to ownership of mining companies that are listed in Canada but might operate in Canada. And finally, the sectoral breakdown, you'll see we most overweight financials, energy and materials. Those are the classic value sectors, and that's we're quite positive on those. So here's the returns of the fund. Year to date, the fund is down only 2% against the MSCI All Country World Index, down 7%. This is to the end of February. And so far, March has been good relative to the world as well, because we are very underweight the Chinese tech stocks. Over 1 year, the fund has outperformed the MSCI All Country World Index and has outperformed this peer group. This peer group is a group of about 12 value managers, global value managers that we follow, that we have a high regard for. And if we're outperforming them, we're quite happy with that. You can see that since inception, we've underperformed the MSCI World, and that is due to value having had a bad run since 2009, 10, around about there. But we're busy starting to make it up now. We think the cycle has turned and value is starting to make a comeback, and we think this fund is very well positioned for that, as the more recent numbers are starting to show. So in conclusion, this fund is also different to most other equity funds and value funds out there. It's very diversified. And again, we think there are many uncorrelated opportunities available in the world, and that shouldn't come as any surprise. And we do think that the value cycle is just getting started, and this fund is very well positioned for that. This bundle of twigs, this global bundle of twigs, is very well positioned for the upswing in emerging markets, in commodities, and in value stocks. And finally, the Counterpoint Worldwide Flexible Fund. This is a fund that I termed the cockroach fund, not because it digs around the dirt and is an unpleasant little animal, but because this is the animal that is said to be able to survive even a nuclear explosion. So it's a very robust animal. And that is what this fund tries to do. The Worldwide Flexible Fund used to be run as a sort of a global flexible fund, acceleration fund, taking view on what was doing well. And it did well for about 10 years. And over the past 5 years, it hasn't been doing that well. So I re-engineered the investment process about 18 months ago. And I'll show you some numbers on that. And as I go through how the fund does, what it does and why it does so, you'll understand what I've done with it since then. And I'll touch on the current position returns. So here you can see the track record of the fund. So for the first 10 years of existence, it did really well. It did fantastically well. And then it got into resources too early in 2014, 2015, and performed really badly. But then the resource started to do well, so the fund did well. And then it got into South African small caps, SA Inc. too early and underperformed again. And since then has done well. And so these two events showed me, not that I needed reminding, but reminded me once again that trying to time the market is a mug's game. It's very, very hard. And this fund used to be sort of a market time. So you'll see that since inception, it's outperformed inflation, but it's had a very bad middle period here, which corresponds to from 2014 to about 2019. Just recently, it started to do well again. And the reason for that is because the investment process has been re-engineered. So what is the fund managed to do? So the philosophy behind the fund is to generate for South African investors. Remember, this is a SA domiciled worldwide flexible fund. So it's a rand-based fund in South Africa, but it invests anywhere in the world. So the goal of the target of this fund is to generate US dollar returns in excess of inflation, 2% plus. So it aims to protect the purchasing power of your capital, of South African investors' capital in hard currency terms, because I think that is what we need as South African investors. We need our capital to be protected and to grow in US dollar terms. And very importantly, it tries to do so with volatility. The biggest enemy of generating long-term returns is being scared out of a fund when it drops a lot. And then you say, you can't take this anymore, I need to disinvest. So we're trying now to manage this fund so that it doesn't have a high volatility of returns, to keep investors on the path of generating good returns in hard currency US dollar terms. So the fund, very simply, is structured to overcome our ignorance of the future, of which I've exhibited a lot in the past, and overconfidence in our ability to predict the future, of which I've also had a lot of. So that was what the fund did as follows. Basically, we're saying at all times, the fund will have around a quarter in hard currency cash, a quarter in fixed income bonds, a quarter in equities, and a quarter in physical commodities, mainly gold, but including some other physical commodities as well. So that is the framework according to which we invest the fund. Within each of these asset classes, we will pick out the undervalued assets within it, and we will over or underweight within very tight limits each asset class. So we'll never go over 30 and never under 20% in any one of these asset classes. So we place strict limits on ourselves to always have a diversified portfolio. And we've backtested this, and it comes up with good returns, good real returns in US dollar terms with low volatility. Because you can see from the asset class we've chosen, under inflation conditions, your gold and your equities will do well, your bonds and cash might not do so well, under cash will do well, your bonds will do well. If there's an equity bull market, at least you've got some exposure to that. So you always have some exposure to something that is doing well, and you always have a protection of cash in down markets. And then when one rebalances, which happens every 3 or 4 months, it doesn't happen very often, you can use the cash to rebalance into any asset that has declined substantially. So that's how we manage the fund. This is the top 10 assets. You can see there's commodities and so on. That's not really an important slide. The important here is the current asset allocation to each one of the different assets. You can see we are maximum overweight cash, mainly in US dollars. We are maximum underweight bonds. We're at 20% bonds. Most of those bonds are emerging market bonds. No, not most of them. All of those bonds are emerging market bonds, which offer decent real returns as opposed to developed markets, which are negative or very low positive yields. We are almost maximum negative equity. We're at 22%, neutral would be 25%, maximum bearish 20%. So we don't have a lot of equity exposure. Most of our equity exposure is towards either small cap value in emerging markets or towards energy and materials equities. And then we have a strong commodity, physical commodity exposure. More than half of that is gold, but we also have silver, uranium, and platinum hard commodity exposure. The rand exposure of the fund, current rand exposure is 35%, and that's mainly through a combination of South African government bonds, which are yielding 10 to 11%, with an inflation rate of 5-6%, low inflation in the US, very attractive high real yields from South African government bonds. And by the way, because of the high commodity prices, our fiscal position is improving dramatically. So we think the bonds have a very strong financial underpinning. And then we have 2/3 of the fund basically offshore. I think the 35% is to South African assets, probably the maximum the fund would ever allocate to. So we are probably at this point maximum bullish on South Africa. So since we re-engineered the investment process of the fund in the fourth quarter of 2020, which was just after the merger of ReCM and Counterpoint, I took the opportunity of thinking about how to actually go about managing this fund, taking cognizance of the mistakes made in the past, and we're quite satisfied with the outcome. The fund has done well over time. It's had good quarters and bad quarters. The third quarter 21, it was down when markets were sort of flat. But I think the important thing, seeing that I called it the Cockroach Fund or nicknamed it the Cockroach Fund, year to date, the fund is up 1.7% in US dollars, where US inflation in the first 2.5 months was just over 1.3%. And very important, MSCI World was down 11.1%. And these numbers are measured to date. So it includes the major sell-off we had and some of the recovery. The fund has held its fund and is actually up in dollars year to date. So it has shown it has attributes of the cockroach, because the first 3 months of this year have been traumatic for many investors. And this fund has produced okay returns in a non-volatile fashion. So to sum up, this fund aims to protect wealth in US dollar terms for South African investors. It tries to do so with a low volatility of returns, and it does so through the 2 free lunches that you have in markets. The first free lunch is long duration mean reversion. So when assets get undervalued over time, they revert to average or even overvalued, and vice versa. The laws of economics determine that. And the second free lunch in markets is diversification. The fund will at all times be fully diversified, and the free lunch available here is low volatility. So satisfactory returns with low volatility. Those are the 2 free lunches this fund tries to generate for investors. And since re-engineering the investment process of the fund in the third quarter of 2020, we think the fund has done its job so far. So with that, I'd like to say thanks for your time. I've carried on a bit longer than I expected, but I think there is some time for questions. Over to you, Jaco.
Thank you, Piet. Yeah, we definitely did get a few questions, and you're welcome to fire away if there are any other questions based on the presentation content that Piet presented to us. Piet, I'm going to start with the. I think firstly I want to address 2 questions which are fund specific. So the question was the Global Value Fund, whether it is a feeder or whether it is dollar denominated. The Global Value Fund at present is only available as a dollar denominated portfolio. It is loaded with 4 of the platforms in SA, so you can access it through Glacier, Momentum, Allan Gray, and Old Mutual International. And we are in the process of creating a feeder structure for it as well, which will make it slightly easier to access through the variety of platforms that are available in SA. And the other question was on basically the other platforms. I mean, the value range of funds are available through all the large platforms out there. There are very few that does not provide access to the Value Worldwide Flex portfolios at present. But then I think the first question that I'd like to put
if you find a platform that doesn't have it, please put pressure on them to put it on.
Yeah, so you can just send a request to info@cpam.co.za, and I'll be happy to trace it down and get it open and accessible for you. Generally, these things are demand driven, so if there are enough requests for it, they will definitely open it up and make it available. But we got 2 very good questions, I think, and it's something that I think you'd like to talk to. The first question is, as a value investor, when do you actually exit positions? Because we went through the whole process of how you construct and how value works, but when do you actually decide to start exiting certain positions?
So there are a few reasons why you would exit. The first one, and that's one that quite commonly happens, is when you realize that actually your investment thesis is wrong or not playing out the way you expected. And that happens very often. And then you will exit the position because you were wrong. A second reason to exit the position is if you buy the share and you're lucky enough to have been right, and it re-rates and it starts approaching fair value. That's when you start lighting up. When you start selling. And the third reason to sell is if you find something better, because this fund is generally pretty fully invested. The value, both the Global Value Fund and South African Value Fund, the equity funds, are pretty much fully invested at all times. And if you find a fantastic investment, then you have to sell something to make space for it. So those are 3 reasons to sell.
The fund, yeah. The question was specific to when it is done well. So I think that certainly answered it. Thank you for that bit. Then it's a question that was asked twice. Is the whole concept of a value trap, and I think you spoke to the risk measures that you've actually put in place. If you can maybe elaborate on what is considered a value trap for those that might not know, and how do you try and avoid them?
So a value trap generally is a stock that looks cheap and then just stays cheap forever. And the unfortunate reality is that you cannot avoid a value trap. If you're a value investor, from time to time, you're going to get involved with a value trap. The way to deal with that is not to try and avoid it, because beforehand, you can't tell which is a value trap and which isn't. You can only say afterwards, well, that was a value trap. That didn't work out very well. I should have stayed away. But it's very hard to do so in advance. So the way to deal with it is to position size it appropriately for the risk. Most value traps are stocks where there is a lot of bad news around, where they've got some fundamental headwinds they're fighting against. And you can recognize those for what they are, the risks out there, and you can size your position accordingly, so that you have, at any particular point in time, a small exposure to potential value traps. So it's all about the position size. That is how one deals with it. Not avoiding them, but actually welcoming them, because that thing that could be a value trap could also be a multi-bagger. It could also turn out to be a 10-bagger. You don't know beforehand, but you need to size your positions appropriately.
Gotcha. I think that's very sensible. Piet, I know you don't like to talk stock specific, but you did mention Naspers earlier, and if you can maybe, the question here is, I think Piet mentioned recently, Naspers has got its challenges. If he can maybe explain and whether it is a value proposition, or when it comes into value. Sorry, I'm going to rephrase that. Sorry, in my own words. Then, basically, when would you consider it to be in value territory as a consideration, and would you actually?
Yeah. So yes, very, very definitely. I think Naspers at some point will and can be called a value proposition for a value manager such as myself. However, this thing isn't a clean proposition. It's quite hairy. First of all, you have a management team that is allocating capital very poorly, selling their jewel in the crown, Tencent, and buying food delivery businesses which are loss-making and other businesses which are loss-making, and where the prospects will never be as good as the prospects of Tencent has. So poor capital allocation of management. The second problem you have there is that you are buying a variable interest entity. You're not buying equity in a business. If you're buying Naspers or Prosus, you're buying shares in a business that owns a contract based in the offshore jurisdiction like the Cayman Islands, which is a contract giving it the right to some of the economics of the underlying business, in this case Tencent. And that contract has never been tested in court and can be revoked or just completely negated unilaterally by the government of the day, just like Russian investors in Russian stocks, such as ourselves, found when we invested in ADRs of Russian stocks. All of a sudden, some government, in this case the UK government, said, well, you're not allowed to trade in that thing anymore, and it's done, it's over, sorry, it's worth zero. The same thing can happen to Tencent for outside passive investors like Naspers and Prosus. So that's a problem. So there are clear and significant risks involved in this business. So how do you deal with it? No, you don't avoid it. You say, if it gets to a level where you're comfortable that you're being paid for the risk, you buy a small position.
Gotcha.
Because there is a risk that this, just like Rebosis A, there is a risk that it can go to zero. So you size your position accordingly, but it might not, and we'll only see a Naspers as a value trap in the fullness of time.
Gotcha. Thanks for that, Pete. Then we've got another question here. What should be the split? And I do think you speak to that in your worldwide flex portfolio. If we can maybe just highlight that again, what should be the split of the local versus offshore in a value portfolio? If you
Yeah, so I think that it depends on each person's individual risk tolerance and risk preferences, and also, very importantly, where your liabilities sit. If you have predominantly South African liabilities, I think it would be fairly unwise to have no South African assets, because there is a chance that South African assets and liabilities become worth a lot more in US dollar terms in the next 5 to 10 years. There is a chance that happens. I'm not saying it's not a forecast, but there is a non-negligible chance of that happening. So each person has to decide that for themselves. For the purpose of the Worldwide Flexible Fund, I think right now, given the valuation of different asset classes, different currencies, different sectors, I think 35% is quite a full position in South African assets.
Pete, this was a question that was asked before your presentation, so during registration, but I think it's an important question. Having gone through, especially the Global Value Fund, the question was: you seem to be strongly pro fossil fuel. Could this mean that you miss out on opportunities within the renewable energy arena? You did mention, some of those mining stocks that you hold globally. If you can maybe just explain your position on some of the renewable energy stocks and why you would, I guess, be overweight on the considered fossil fuel companies.
Yes. Okay. So let's be very clear on the difference between my preferences in terms of economics or the type of energy I use personally or anything like that, and my investment preferences. Just like I do think that South Africa is in danger of becoming a failed state, that does not prevent me from investing in South Africa, because I think the investment proposition is strong enough to justify that. Just like I am all for a transition to clean energy to reduce the amount of carbon in the atmosphere. But right now, the way renewables are priced, the investment returns will be substantially below what one requires to make an investment decision, because it's so popular and priced to perfection, and you can see it even in the most recent round of for the South African clean energy. I forget the terminology now, but I think they bid 47 cents a kilowatt. 47 cents. They're not going to make money at that price. They're just not going to make money at that price. So I think the returns from investing in clean energy right now are very low, because it's so popular to be there and there's a lot of capital chasing it, whereas the returns from investing in fossil fuel industries is quite high, because there's no capital there, nobody wants to invest there, and that's been proven over the past 18 months. Fossil fuel companies have by far outperformed clean energy companies. It's been a fantastic place to invest in, although would I personally want to be involved with a fossil fuel business? No, I don't think so. I prefer clean energy and electric vehicles, but if you're going to invest based on your personal preference, you're never going to make any money. That's just how it works.
100%. Thank you for that, Pete. I think we have kind of run out of time, so I'm going to use the last minute just to wrap up today's presentation. Pete, thank you so much for sharing your insights, and once again, thank you to all the audience members for spending some time with us. We do have, especially for those looking at accessing the Global Value Fund, we do have access to a company that can assist us with Forex conversions. If you do need any assistance with that, you're welcome to contact us at info@cpam.co.za. Just a quick reminder to please take a minute and complete the survey for us at the end. Once again, your feedback is incredibly important to us. We definitely use all of that in improving these systems going forward. And our next webinar will be on the 6th of April, Wednesday at 9 o'clock. So in the morning, as we usually do, not in the afternoons. And so that'll be by Raymond Shapiro, and it'll be on the quality franchise and the offering that we've got within that space. So thank you so much for your attendance today. If you do have any questions, please reach out, and we look forward to seeing you at our next session. Thank you so much. Thank you, Pete.
Thank you. Thank you, and goodbye.